Okay guys, I thought I'd also run a lower time frame simulation for yourselves as well to see how the week developed and what type of trades we could have taken on the lower time frames, because it is quite difficult to also read candle structure on the higher time frame candles if you don't know how they develop and what the wicks and the candle bodies mean. So the lower time frame structure, obviously what we will run through now is the same wick that we just ran through on the 1 hour, and we can see here we've got a bullish trend occurring on the lower time frame. If we zoom out a bit, we can see that it's part of a higher time frame bearish pullback and a bearish trend and a complex pullback. We can see that it's respecting certain higher time frame points in the chart. We've marked up here inefficiencies in the market from previous weeks' confirmations, and we're looking for the market to respect these higher time frame inefficiencies and possibly even the higher time frame supply zones. So we will effectively see how the week plays out, mark out these zones and understand what the market is doing and try and develop an understanding of market structure playing out. Okay, so the market enters in inefficient zone tail end of last week. Over Asia, Sunday of last week, it comes in to play and it sells down bearish. We can see a break of structure here occurring, but the market has broken structure intermediate to the downside initially here and then confirmed it again here. Okay, this is our break of structure. And what we're looking at is a possible retracement and pullback from this area, bearing in mind this is also a demand candle, so we could see a large pullback past this point here, or it comes and pulls back either into this area to then sell down from this supply candle further, or it comes and it moves up from this demand candle by printing bullish structure and then moving up and continuing bullish past this point. So what we'll do is we're now pre-London Open. We possibly would be looking to target a London OTE entry on this. Depending upon the bias that we've got, it's at the moment bearish. We'll see if there's a bullish reversal occurring. So we see the market rejects down to the downside at 7 o'clock, stay out the trade, rejects again into that demand candle, starts to sell up. So we're seeing rejection now to the downside. Probably try and get in on the next candle if it breaks bullish again. Okay, we'll enter this trade. So what we would do is we would enter the trade bullish at this point, set our stop loss at the bottom of this demand candle. Okay, so we've got a 4.5 pip stop loss, and we're now targeting sales to the upside, possibly to break this high here. We 1 to 5 trade. If we're looking to stack the trade, we would take that and target highs as well and see exactly what plays out. So let's level these up. 22. Okay, see what happens. Boom, TP1 hit, market rejects, and it comes back and it stops us out. So TP1 hit, 5R gained, break even here, so we're out of this trade. Market comes back, breaks the demand zone and respects another candle at the bottom. So it may well be coming back to take liquidity off this buy that people were in. And we want to see whether it respects the demand candle here or the lower point here. So we develop our bottom line at this point. We want to see the market respect the zone. Respects the zone, starts turning the other way, it breaks again to the upside. Okay, we're going to get in the trade again. So it's taken liquidity to the downside, it's breaking to the upside. We get in on this wick, rejection here. We set our stop loss below the lowest point of the market's now created, 4.5 pip stop loss there, and we see whether the market's going to continue now to the upside or it's going to target this supply candle to get into a short-term buy to then sell down deeper. Let's say we stack this trade again as per convention. Okay, and we're buying up again to see if the market now moves bullish. However, breaker structure has been created to the downside. We're expecting it to respect this breaker structure to the downside by the pullback that it's already created. respecting this again and come to the downside. So we'll play the chart and see where we go. Okay, TP1 hit again. So we are now, let's put this up. So we took 5R before. We're now 4R in again. Yeah, 4R. Okay, so TP1 hit again. So 5 plus 4, we're in 9 at the moment. Let's see how it plays out. Break even. We've broken even. Let's be realistic about it. We've broken even. That trade's off the trade table now. So let's see what happens. Okay, market's rejected the downside. This trade's dead. Okay, so 5 and 4, 2 break evens. Market's rejecting the downside. It's broken the low here. So what we're now looking for is a possible retracement to the upside, rejection from that point down. We weren't really concentrating on sells from this point, but this was also a counter trade trend that could have been taken when the market started rejecting off here. We could have taken a sell down. However, we are at the moment in sells bias, and we are effectively now looking for a confirmation of that sell where the market has broken through this demand zone. It's shown us potential to go lower. We want to see a retracement into this area to then sell down. So we'll play the market and wait to see if we get any form of entry. Okay, this is a supply candle. An intermediate supply has been induced in the market here. If this area now gets respected, we want to see whether the market respects this area or it targets the candle above in this zone to see whether we're going to go for sells. So let's mark up these two areas. There's a number of points here that we could be targeting. However, the larger zone is here. Let's get rid of this smaller zone. That's the larger zone. Let's see if it targets. There is also a supply candle up here, which has been respected to a certain degree and mitigated a little bit, but we're going to see if this zone gets respected initially. Market comes up, takes 50% of that zone. We're now looking for rejection to the downside to confirm a sell. The market comes, mitigates deeper, starts to reject. Okay, if it rejects again and it respects that wick that's been created, we're going to get in on a sell. Okay, breaks up, is very, very limited on the zone. It's tapped into the supply candle above. We want to see now if it respects this zone above. And if it starts rejecting off this, we'll then now look for sells. Rejecting, rejection again. Confirmation. Okay, we're going to get in on a sell here. So we'll get in on a sell and we'll set our stop above this supply zone to sell down deeper into this demand zone. Okay, stopped out. Okay, we are 1 hour down. So okay, this is stopped out. However, it's respecting the zone above. So now what we're looking for is respecting of this high that's been created. This trade comes off the table. And we're now going to check and see whether this area gets respected. I doubt it. It's moved very aggressively into the zone. And it's only just started to reject. It may well be moving further up to break structure to the upside. Our structural point that we want to see respected is this. It's currently the protected high. So we want to see whether it now breaks above this, gives us confirmation for buys, and we'll look for buy opportunities. Market comes, breaks structure, we're looking for buys. Continues higher, continues higher, continues higher. Rejects, rejects. Okay, it continues to consolidate, continues to buy up. There's no opportunity here to be had for a buy. What we were effectively looking for is buys actually broke intermediate structure here. There was no real pullback for us to get in on, and the market continued to buy up. So effectively, out of the demand zone that was created, this wick got taken out. Lower time frame demand zone was respected here. The market bought up, broke lower time frame structure. There was buy opportunities here. We haven't paid attention to them because we're looking for sell bias at the moment on the trend that's been created. We're now buys, so this removes, and we are now buys bias pro trend. So let's see how the market delivers and what it gives to us in terms of a zone to be respected. This high has been taken out, so we are buys, and previous areas are now being tapped. So we're looking for buys. Market comes to reject, consolidates, continues to move higher. Okay, we're now at daily supply. So we disrespected that zone. We disrespected the zone above, which was also a supply candle and an inefficient zone. It's now into a daily supply. So we're now possibly going to be looking for rejection to the downside and confirmation of sells. So we're in the daily supply. It's 2 days into the week and we're entering this zone. Market comes in, 50% taken, starts to reject. Okay, we rejected twice off the zone. We're going to wait for lower time frame confirmation. Rejects off the zone, breaks lows, retraces back up, testing the zone, rejects. Okay, we're going to get in on sells here. So the market is struggling to break above the point that it's created as a higher level here. It's giving us a consolidation at this point. We'd enter on the next candle. Market forms. We enter on the candle. We set our highs, stop loss above the highs, 5 pips. We're going to take it to the downside. We will now be targeting a demand candle on the lower time frame, possibly even down to where the market broke structure previously. So we'll target this demand candle down here, where the market moved off and broke structure to the upside. Yeah, that's the last point where it kind of broke structure. This would be one trade that we're looking at. And if we're going to stack the trade, we probably put another trade alongside and target the actual demand level that created the push up, which could possibly be this area of consolidation here. Let's target that and see how the market plays out. TP1, boom. Okay, 9R. So we are 9R and TP2 at break even. And we see how the market plays out. Boom, TP2, bang, 11R, 12. Okay, so we've got downside momentum. Both trades are safe. There are obviously re-entries that could be had here as well. However, we'll just look at the initial entries and see how they play out. The market now is continuing to the downside. We're going to continue to watch it and see whether it now comes into any of the demand zones, gives us rejection to the upside, or it continues to the downside. Continues to the downside. Continues to the downside. Comes to this demand candle here and now moves off to the upside. This is the zone that we're targeting in terms of consolidation to the upside. Touches that zone and flies off in the opposite direction. We want to see it respect these highs to see whether the momentum continues bearish or whether it's now going to break bullish. Comes up, testing the area. The highs are being tested, highs are broken. So intermediate highs are taken, possibly looking to go bearish. So we're going to look for reconfirmation, goes bearish, breaks the highs, pulls back, continues higher, consolidation. It's now testing highs that it created previously, where the daily supply was taken, and it's now rejecting in that same area because we want to see whether it respects the highs and continues bearish. This is a complex pullback. We've got consolidation, expansion, retracement, and we're now looking for sells again. The sells will respect the highs that have been created. Let's see if we've got anything further back that we can target that it may come to liquidate. Okay, we've got a supply candle at the top here as well, so let's mark this as our uppermost level. There's a level here that has not been targeted efficiently. There's also imbalances within that zone that could possibly be targeted. This looks like very efficient price action. Okay, there's no real reason for price to return here from what we can see in terms of structure, and everything back here looks efficient. We've got inefficient zones above, but let's concentrate on the daily demand supply zone. So the red line that I've marked at the top is our uppermost level of protected highs. This is the protected highs most recently, so we want to see if the market respects that. Market starts to rejects again and again. Okay, next candle we're going to get in if it basically opens bearish. Market opens. We will enter on this candle as it forms. It's now very, very close to highs. It's drawing down. However, it's given us a channel of rejection. Hasn't broken structure to the downside as yet, so we're going to stay out. Stay out. Highs get taken. Market starts to reject. Continues to reject. Breaks low. Rejects back. And now is going bearish. So we're going to get in on the next candle if it's bearish. Okay, we're going to get in on this candle. So we've got intermediate structure that we were looking to break. The market broke higher, however, then started to respect that zone. So this could just be liquidation of these highs, and it's come and it's taken previous structural points here on the lower time frame. It's given us a confirmation of bearishness. It's come up. It's now rejecting to the upside. So we're going to get in on this candle, and we will set our highs at the uppermost point previously, which will be an 8 pip. If you wanted to be very, very risky, you could set it here at 5 pip. Let's be safe and just set it at 8 pip stop loss up there. See how the market moves. We're looking for it to now sell down and possibly even take lows. But initially, we'll target these lows and we'll stack with another trade and target the deeper lows. See how the market plays. Boom, TP1. And you can see how important it is to hold your nerve. Okay, so the market's come down, reversed, drawn down. We've drawn down almost 8 pips. Thank God we basically had our stop set at the predicted high. Okay, so we've gained another 5 TP there, 5R there. So let's bang that on. And we are at break even on TP2. And let's see how it runs. Boom. Okay, 10R. Right, and I think that is the week done. Yeah, okay, great week. Right, so let's put it together. So we've got 5 plus 4 minus 1 plus 9 plus 12 plus 5 plus 10. We are 44R, ladies and gentlemen. So for the week, we are 44R up on very, very basic market structure being followed and trades being set according to structure and respecting highs and lows with decent, respectable stop losses. We're not looking for crazy type 2, 3, 1.5 pip stop losses. We were doing 8, 7, 10, 6. Okay, and even then, we're at 44R. If you're risking 0.2 per trade, 44 times your 200 risk on the SL, you are very, very healthily up 8.8% for this week on your account. Okay, so we are in the money, 8.8k. And this is just by us respecting our zones and doing what we need to in terms of reading market structure. I hope this has been beneficial. It has been eye-opening to myself, and I hope it has been to yourselves. And it shows us how very, very simple it is to make money in the markets if you follow the principles and you understand how to read market structure and do what the market is telling you and follow the directions. Follow the signs to your destination. That is all trading is about. No gambling. There's no game of chance here. It's follow the signs to your destination. As easy as that. And the chart, when it prints the candles, is your sat nav. Just do what it says and set your losses at where you need to, set your TPs where you need to at defined zones and areas that are going to be respected in the market. As I said, once you understand how to read market structure and candles, it is a beautiful thing to look at, and it's an art form. And I'm being passionate about it because I've learned how to do it over months and months and months and hundreds of hours. And I'm still not an expert, but when it goes according to the plan, there's nothing sweeter than knowing that the fruits of your labor are now bearing fruit and you can feel the sweetness. And this is clearly an example that we've just run through. Very blind, I'll be honest with you. I haven't done a backtesting simulation on this for this week. I was supposed to do it, and I've just done it with yourselves live. And it just shows you that even though you will have losses, you will have winners. If you set your risk management in the correct manner, there is a great, great opportunity to be had to the upside. And clearly here, you could have very easily have made 44R just trading market structure on the 15-minute time frame and not caring about anything else. But you would have to have done your analysis prior and marked your higher time frame zones to know where the market is going to come and respect, reject, or bounce off. And that is a key. It's very easy to understand the market structure concepts, smart money concepts, retail strategies, whatever you want to call it, support resistance. You want to understand how the market moves. And you also will need to know how to implement the knowledge that you have gained about market structure as the chart is developing live. And this is why I say simulations are more important than backtesting, because backtesting, you already have the cheat sheet. The answer's already on the screen in front of you. If you go and drop the replay tool anywhere in the chart, and you then do your analysis from that point onwards, and you press play, as I did, one candle at a time, let it develop and read what the market is telling you. Only then will you understand whether you have grasped the concepts fully. And if you continually see yourself getting stopped out, try and understand why that is happening. No mentor, no mentee, no colleague, no person who's willing to assist you in the markets is going to be able to turn that switch in your mind. You're going to have to spend time on the charts, doing simulations, and actually understanding why the market moves at certain points. And, you know, there's nothing like reading structure. Very clearly, we can see that throughout this week, from the 18th onwards, as the market creates moves, it respects areas that are predefined as areas of reversal, rejection, and consolidation. So we can see the market comes, respects an area here, which we said was an imbalance. On the lower time frame, it's actually a demand candle. So it comes, moves off that demand candle, comes up to this point, respects this area, which is we know is a daily supply because we've marked it. And I marked it for ease of reference for you guys and as well as myself. 50% of that area, once it gets mitigated, we are confirmed for sales. We want to get the market to confirm to us that it wants to sell, which even on the higher time frame, it does here. It breaks structure for low points, and then it retraces back into the area where it caused the move from, liquidates that area, I think, to a certain degree we saw. That's basically where an FU occurs. It liquidates the early sellers at this point, smacks them out of the chart, comes back, confirms the sell again, respects the high that it created by taking all these sellers out, and then moves away to the downside. So there are intraday sales that could be had, and there are longer swing trades that could be held. And if you use the entire zone that is to be respected, you do have a chance of holding these trades longer. Set your stop losses at a reasonable level. Don't go for mad tight stop losses and thinking you're going to make a killing. It's better to be in the trade and risking an additional 3 or 4 pips on your stop loss than being stopped out and then the market moves 40 pips in the direction that you were correct with your bias. So I hope it's beneficial. I'm going to upload both of these videos now, and I hope that it helps you for your forecasting and your trading for the week ahead. As before, if you have any questions, drop it in Instagram, send me a DM, and I'll try and assist as best I can. Take care.